Most traders believe success comes from being right, from knowing exactly where the market is headed. But the market doesn't reward being clever. It rewards being steadfast. And that steadfastness is built on risk management. I don't manage risk out of fear. I manage risk to claim my freedom from panic, from chasing losses, from the desperate need to be validated. Risk management isn't a shield. It's a strategy that lets me remain at the table long enough for my edge to work. When you genuinely understand risk, losses cease to be personal. They stop being a commentary on your skill. They no longer provoke anger or the urge to fight back. Risk becomes simply a calculated cost, planned, contained, and agreed to up front. I remain profitable not by preventing losses, but by stripping them of their emotional charge. Most traders think they accept risk, but in truth they merely endure it. Endurance is temporary, acceptance is complete. There's a profound difference between thinking a loss is possible and feeling total peace with that loss before the trade is ever placed. One is a thought, the other a feeling, and the market reacts only to what you truly feel, not to what you claim to know. I accept risk before I enter because once I'm in the trade, it's too late to reason with my emotions. The market doesn't stop for my anxiety. It has no interest in my goals or my story. If I enter without full acceptance, I surrender control to fear, and fear demands guarantees where none can exist. Risk acceptance means that before I click buy or sell, I have already faced the worst outcome, and I am genuinely okay with it, not indifferent, not braced, but truly at peace. That potential loss no longer holds emotional power. It doesn't shake my confidence or make me eager to win it back. It's just one possible result in an unpredictable world. Most traders enter the market hoping price will obey their expectations. Hope is a silent bargain with the future, and the market never honors it. Hope creates clinging. Clinging creates fear. Fear breeds doubt, reckless actions, and distorted judgment. The instant price moves against you, your mind looks for reasons. What did I do wrong? Is my analysis flawed? Should I hold longer? None of those questions come from a calm strategy. They arise from risk that was never fully accepted. When risk is truly accepted, nothing the market does surprises you. Surprise exists only when you expect one thing and get another. If you've already accepted that anything can happen, then whatever happens feels expected. There's no jolt, no emotional surge, only data. Accepting risk before entry disarms the emotional force of not knowing. It frees you from the urge to control every outcome. You no longer stare at the screen as if each tick judges you. You stop reading price action as praise or criticism. The trade becomes what it always was, a probability play with a predefined expense. I don't accept risk to save my capital. I accept risk to preserve my mindset. Money can be recovered. Emotional turmoil accumulates. Once fear infiltrates your decisions, discipline dissolves quietly. You won't even see it happening, because in the moment it feels justified. You rationalize widening stops, closing early, taking setups outside your plan. Every excuse grows from unaccepted risk. True risk acceptance requires certainty about just one thing: the amount you are willing to lose. Everything else is left uncertain on purpose. The paradox of trading is that the more you embrace uncertainty, the steadier your performance becomes. Steadiness isn't about controlling the market, it's about aligning with its chaotic nature. When I accept risk before the trade, I no longer need the trade to succeed. That one change alters everything. Need is emotional attachment. Attachment creates tension. Tension warps perception. When you don't need the trade to win, you see the market plainly. You can let the trade develop without meddling and stick to your rules without compromise. Most traders believe confidence comes from winning. In truth, confidence comes from knowing that a loss will not shake your emotional core. That knowing gives you courage. Courage is what lets you act when your edge arrives. And action is all you truly govern. To take on risk is to take on responsibility. I do not fault the market, the headlines, the system, or the games. The market did only what it was permitted to do, move without certainty. I selected the risk. I defined the loss. If the loss arrives, it is a fulfilled contract, not a wrong. This frame removes revenge trading, because there is nothing to repay. You were not wounded. You paid a fee. Professionals do not seek vengeance against overhead. They manage it. When risk is accepted, time stretches in the mind. There is no hurry, no emergency, no pressure to move. You can wait for your setups. You can skip trades. You can watch chances pass without unease. Scarcity vanishes because you know opportunities are endless, but capital and discipline are finite. Most traders undermine themselves because deep down they believe each trade matters. Importance breeds attachment. Attachment breeds fear. Fear drives errors. Accepting risk strips importance from single trades. The only thing that matters is following the process. And here is the reality most deny. You cannot accept risk while quietly trying to escape loss. Avoidance feeds fear. Acceptance disarms it. The market will take money from you. That is not defeat. That is taking part. I do not enter trades asking how much I can gain. I enter knowing exactly how much I can lose and being fully at peace with that figure. Profit is the outcome of execution, not the goal of the moment. When risk is accepted, stops are not painful. They are factual. They are merely signals that this particular probability event did not go your way. Nothing more. This mindset is not innate. The human mind is built to evade uncertainty and pain. Trading requires the opposite comfort with uncertainty and willing exposure to loss. That is why most never master it, not from lack of intelligence, but from refusal of emotional responsibility. Accepting risk before entry is an act of self-command. It is the instant you stop pleading with the market to shield you and start shielding yourself from your own reactions. Once you do this steadily, trading grows calm, even dull, and dullness is a sign you are no longer emotionally knotted to results. You are simply running a system in an uncertain environment. That is the bedrock of consistency. That is the bedrock of profitability. And that is why I accept risk before I ever enter the trade. Most traders think risking small is about guarding their account. That view is shallow. The true purpose of risking small is to guard clarity. Clarity is a trader's most precious asset, and it vanishes the moment a position size carries emotional weight. I risk small so I can think clearly, because the market demands objectivity, and objectivity cannot live alongside emotional pressure. The instant a trade feels important, your mind begins to warp information. You stop seeing what is there and start seeing what you wish were there. That shift is subtle, but it is where discipline silently dies. Large risk creates a mental imbalance. Every tick starts to count. Every pause feels menacing. Every swing begs interpretation. The market hasn't changed. Your perception has. When too much is on the line, your brain enters survival mode. And survival mode clashes with probability-based decisions. Risking small keeps me neutral. Neutrality lets me observe instead of react. It lets me follow my rules instead of bargaining with them. When risk is small, I feel no urgency. I feel no pressure to be right. I feel no need to control the outcome. I can let the trade work or fail without meddling. Most traders fail to see that emotional intensity scales directly with position size. It doesn't matter how confident you feel before entering. Once price moves, the truth emerges. If your pulse quickens, if your breath shifts, if your focus tightens, the risk is too large. At that point, discipline is already broken. I risk small because I want steadiness, not thrill. Thrill is a sign that emotion is present. Emotion clouds judgment. The market does not reward passion. It rewards precision. Precision demands calm. When risk is small, losses lose their sting. They don't pile up emotionally. They don't breed fear of the next trade. They don't demand payback. They simply become data points in a long series of trades. That is how probabilities play out, through repetition, not force. Many traders try to trade big to make money faster. What truly happens is they shorten their life in the market. One emotional choice leads to another. Stops are stretched. Rules are bent. Trades are forced. In time, the account mirrors the mental turmoil. Risking small lets me stay present. Presence means I can notice when conditions shift. I can notice when my edge fades. I can step aside without emotional fight. When risk is large, stepping aside feels like failure. When risk is small, stepping aside feels wise. Clear thinking also means accepting that not every chance must be taken. Small risk removes the illusion of scarcity. I don't feel this trade must work because another opportunity always follows. The market is infinite. My capital and discipline are not. I don't measure success by what I make on one trade. I measure it by how faithfully I execute my plan. Risking small makes that possible. It aligns my emotional state with my strategy. When risk is small, I can follow my stop without pause. I don't wince when it's hit. I don't nudge it, just a little. I don't freeze and hope. I exit because the plan demands it. Clarity produces obedience to rules not through force, but through emotional alignment. Most traders think they need confidence to trade well. In reality, they need comfort. Comfort with loss, comfort with uncertainty, comfort with waiting. Risking small creates that comfort naturally. You don't have to fight fear when fear has no fuel. Large risk magnifies random outcomes. A normal losing streak feels catastrophic. A normal drawdown feels like a crisis. Small risk keeps normal variance feeling normal. That psychological stability is what allows you to survive long enough for your edge to play out. When I risk small, I can think in probabilities instead of outcomes. I don't care if this trade wins or loses. I care if I executed correctly. That focus is impossible when the result feels financially significant. The market is not a place for emotional expression. It is a place for disciplined execution. Risking small removes drama from the process. It turns trading into a business instead of a personal battle. I do not increase size to feel powerful. I increase size only when my consistency proves that my clarity is stable. Size is a privilege earned through discipline, not a shortcut to profits. Risking small also keeps me honest. It exposes my habits without punishing me for learning. Mistakes become lessons instead of disasters. That environment accelerates growth. The irony is that small risk leads to larger profits over time, not because each trade makes more, but because consistency compounds, emotional stability compounds, discipline compounds. When risk is small, I am free. Free to wait, free to pass, free to exit, free to re-enter. Free to think. That freedom is what allows me to operate at my best. And that is why I risk small, not to limit my potential, but to unlock it. Most traders approach the market as if every trade is a personal test. A win means they were right. A loss means they were wrong. That framing is the root of emotional instability. I do not think in outcomes because outcomes are random in the short term. I think in probabilities because probabilities are stable over time. The market is an uncertain environment. No setup, no pattern, no signal can guarantee a specific result on the next trade. The moment you expect certainty from an uncertain system, frustration is inevitable. Thinking in probabilities aligns your mind with how the market actually works, not how you wish it worked. When I place a trade, I do not ask, will this trade win? That question is meaningless. Instead, I ask, does this trade fit my edge? If it does, my job is done. The outcome is irrelevant to my responsibility. My responsibility ends at execution. Most traders emotionally attach to individual trades because they believe each one matters. It doesn't. What matters is the series. A single trade is just one data point in a large sample size. Judging yourself based on one outcome is like judging a casino based on one spin of the wheel. Casinos don't think in outcomes. They think in probabilities. They know that some players will win today. They know that luck will swing temporarily. But they also know that over time their edge expresses itself through repetition. That same logic applies to trading. Thinking in probabilities removes the need to be right. Being right is ego-based. Probabilities are process-based. When ego is involved, fear appears. Fear demands certainty. Certainty doesn't exist here. Most trading mistakes come from outcome-based thinking. Exiting too early because you want to lock in profit. Holding too long because you don't want to accept a loss. Skipping valid trades after a losing streak. Overtrading after a win. All of these behaviors are attempts to control outcomes in a system that cannot be controlled. When I think in probabilities, losses stop feeling like failures. They are expected. They are necessary. They are built into the system. If you cannot emotionally accept losses as part of the process, you will never be consistent. A probabilistic mindset means I know that even a perfect setup can lose. That knowledge prevents surprise. And surprise is what triggers emotional reactions. When nothing surprises you, nothing destabilizes you. Most traders say they understand probabilities, but their behavior proves otherwise. If you hesitate to take a valid trade after a loss, you are thinking in outcomes. If you increase size after a win, you are thinking in outcomes. If your confidence fluctuates with your P&L, you are thinking in outcomes. Thinking in probability stabilizes confidence. Confidence becomes rooted in your process, not your results. That kind of confidence doesn't fluctuate. It doesn't need reinforcement. It's quiet. When you think in outcomes, you trade to avoid pain or chase pleasure. When you think in probabilities, you trade to execute your edge. The emotional tone is completely different. I do not try to predict what the market will do next. Prediction implies certainty. I simply identify when my edge is present and act accordingly. Over time, the math does the work. Probabilistic thinking also removes impatience. You don't need to force trades because you know opportunities will repeat. You don't need immediate results because you trust the series. Most traders sabotage themselves because they want validation. They want proof that they are good enough. The market is not a source of validation. It is a statistical environment. When you stop assigning meaning to individual outcomes, you stop emotional roller coasters. Wins don't inflate you. Losses don't deflate you. You remain centered. This mindset also eliminates revenge trading. There is nothing to get back. Nothing was taken from you. The outcome was simply one of many possible results. Thinking in probabilities requires emotional maturity. It requires accepting uncertainty without resistance. It requires letting go of control while maintaining discipline. The paradox is that when you stop trying to control outcomes, your performance improves. Clarity increases. Execution becomes cleaner. Mistakes decrease. The market rewards those who align with its nature. Its nature is uncertainty. Probabilities are the language of uncertainty. I measure my success by how well I execute over a series of trades, not by my last win or loss, not by today's P&L. The series is the only thing that matters. When you truly think in probabilities, trading becomes calm, almost boring. And that boredom is a sign of mastery. That is why I think in probabilities, not outcomes. Risk management is not a technique. It's a mindset. When you accept risk before entry, keep it small enough to think clearly and commit to probabilities instead of outcomes. Trading stops being emotional and starts being consistent. Losses lose their power. Wins lose their influence. What remains is disciplined execution in an uncertain environment. That discipline is what creates longevity, stability, and profitability. Master yourself first, and the market no longer controls